Well, good morning once again. Thank you for joining us this morning. Mark Hunter at the Messer Financial Office. And as always, we're going to begin our day with some information from one of our partners actually today, Benchmark, and Bob Long. And we're going to do some information sharing as a comparison to carriers that we already have contracts with. And again, as always, we'll review those benefits at the end. Make sure that you place yourself into a contract with the carriers that we're using. And then, of course, take advantage of the benefits that we'll be showing you today. With all that in mind, I'm going to just get us started this morning. Good morning, Bob.
Good morning, Mark. Thank you. I'll go ahead and get started, Mark, and I'm sure you guys are going to record this for those that wish to join in later or those that couldn't join us this morning. Thank you, Mark. I appreciate anyone who got up early today to tune in. I know there's a million other things to do, but for those of you that can and will and are going to participate, I know from my sales experience, and I still am involved in sales, that this is going to be something that's going to be add to your knowledge and add to your confidence. Not only that, but it will give you information which your prospects and your clients need to know. There's a lot of fine differences between accelerated benefit riders, long-term care riders, long-term care benefits, chronic illness benefits, and there are some legalities involved, and we'll go over that. So those of you that are participating, this will be something worthwhile for you. Thank you. Okay. First of all, there are two different approaches to adding these benefits to life insurance policies. First of all, I think it's tremendous that there's something now to add another true dimension to life insurance sales with these riders that offer additional benefits that allow people to have choices that they wouldn't otherwise have later on in life or whenever a critical illness occurs or a chronic illness occurs. It gives choices that otherwise wouldn't be there. And many times it's going to be more beneficial to have a benefit now when one of these events occurs than waiting a year, 2 years, 5 years, 20 years before the death benefit's paid. So it's a matter of need. It's a matter of choice. It's a matter of having that option out there. So, first of all, there are two different federal IRS guidelines under which these benefits fall. First of all, there is the life insurance policies that offer accelerated benefit riders, ABRs as they're called. And I'm going to talk mainly today about chronic illness. I will get in later some things on critical illness. But the main difference is today, when we talk about legalities, responsibilities, liabilities, and understanding, is going to be primarily on chronic illness and long-term care. And those are two different things, basically. The chronic illness riders come under 101G, which is basically the provision in the Internal Revenue Code under which life insurance falls. So basically, if somebody has a chronic illness rider on their life insurance policy, it's going to pay out a benefit that comes under 101G. It's going to be an acceleration of what otherwise would be a death benefit. Number two, there are life policies that have additional long-term care riders. Some of them, and you'll see later, some of them will be true, honest-to-goodness long-term care benefits as they fall under Section 7702B of the Internal Revenue Code and are treated differently. There are different tax implications. There are different benefit implications, and we're going to go over all that in the next 35 or 40 minutes. So, life insurance policies, let me do one thing quickly here. I want to do a full screen mode. There we go. Under 7702B, these are life insurance policies with long-term care riders that may be chronic illness riders or they may be true long-term care riders, and we'll get into that in a few minutes. This also applies to asset-based long-term care insurance because, for example, with State Life, which is a member of One America, and in my perspective, and I've worked with these policies for many, many years, State Life of One America has the absolute best portfolio of asset-based long-term care that exists out there. And that would be a day for another webinar that we might do down the road somewhere, because asset-based long-term care is gaining lots of momentum when compared to traditional long-term care. Okay. Under 101G, which is again what life insurance falls under, any amount received under a life insurance contract is for a person who is deemed as chronically ill will be treated as the payment of a death benefit, an early payment of a death benefit before death occurs. These policies that have these chronic illness riders typically pay on an indemnity basis. Now, is that an advantage? Absolutely. If there is a claim, period, you don't have to deal with any bills. It's not a reimbursement. Money is paid out. And when that money is paid out without question, it gives lots of leeway and options to the family as to how that money is spent. They can spend it any way they want to. If they want to pay a family member, a friend, a neighbor, a church member, whoever it may be, a volunteer, whether they're trained or not, they can pay that money as they wish without any strings attached. So indemnity is good. Now, there may be one negative implication to that, and I'll get into that now. Under 7702B, which is what long-term care falls under, is actually related to the HIPAA regulations in terms of how long-term care is treated and how it's looked at by the government. Life policies that have a true long-term care benefit that meets HIPAA regulations, and those fall under Internal Revenue Code Section 7702B. They offer more comprehensive coverage. These are usually paid on a reimbursement basis. Now, the other thing is that these are typically, and there are always exceptions. If you've been in the insurance business longer than 3 months, you know there are always exceptions to everything. But primarily, these policies are going to pay benefits that are on a dollar-to-dollar basis without any discounting. They're typically optional benefits. And when they're typically optional, there's a payment for that rider. It's not free. Most often, the accelerated benefit riders, which include terminal, chronic, and critical illness, those are what we call endorsements. They're built into the policy. You don't have a choice whether you want it or don't want it. It's there. Most of them are without additional cost. Whatever the premium is, that's what the premium is. You have these riders. You may or may not make use of them. They're endorsements. The optional riders that typically fall under 7702B, not always, and we'll get into that in just a minute. Those are optional at cost, and they're going to pay out a benefit on a dollar-to-dollar basis. When I say a dollar-to-dollar basis, it's going to come from the death benefit, but it's not going to be discounted because of an early payment. We'll talk about that in just a minute as well. Marketing guidelines include the fact that if these benefits come under Section 101G, we cannot, the company cannot use the term long-term care in marketing these accelerated benefit riders, nor in any literature, whether it's the company literature or whether it's literature that you create yourself. Those provisions that come under 101G are chronic illness benefits, cannot be called long-term care because that's a legal term that falls under 7702B. On the other hand, life policies that will pay out a benefit under 7702B can be called long-term care because they meet the regulations as they fall under 7702B. Some of the names of some of the companies that you all have access to, these are some different names. Excuse me, but notice that in none of the names, the term long-term care doesn't exist. You've got the accelerated access solution, the life enhanced accelerated benefit riders, enhanced care benefit, and so on. But none of these use the word or the term long-term care. Now, excuse me for just a second. I'm going to cough. I've had a little cold and a little, maybe an allergy. So my throat's tickling, so hang on just a second. Okay, that's better. Thank you. Here's an example of how one accelerated benefit rider is written up in a policy for an accelerated benefit under 101G. Notice that it mentions the fact that in this policy it requires permanent confinement to a nursing home, for example. In the second part, when you go to an additional rider under the accelerated benefit, it talks about chronic illness, unable to perform 2 of the 6 ADLs for at least 90 days. For this policy, that's a recommendation. That's a requirement that someone must have those, be in that situation for 90 consecutive days. Each company, excuse me, and each policy has its own definitions how they're going to pay out whenever these events occur. Chronic illness riders under 101G can be handled by each carrier in a different way. For most, the charge is already built in when you buy the policy. There are a few that charge interest on money that's extended under this, but that's the minority of the companies. Most do what's called actuarial discounting. The company looks at the age of the client, the underwriting classification, the gender, the interest rates at the time of the claim. These are some of the things they look at when they determine how much they're going to discount a claim under an accelerated benefit rider at the time of claim. We'll look at some examples in a few minutes. As a matter of fact, right now. Here's an example of discounting. Now, the first column we're going to look at is life insurance with long-term care benefits under 7702B. If the death benefit on that policy is $300,000, and for that company, the maximum benefit payout per month is 2% of the death benefit. 2% of $300,000 is $6,000 per month or $72,000 per year. So in this case, this person who submits a claim receives $72,000 per year or $6,000 a month, and the death benefit is reduced dollar for dollar. $72,000 comes off the total death benefit, and you can look at year 1, year 2, year 3. Each year, when that insured receives that $72,000 or $6,000 a month, the policy is reduced dollar for dollar. In other words, those death benefits, or what was originally a death benefit, is going to be accelerated, but under this rider, under a true long-term care rider, 7702B, is a dollar for dollar reduction. On the other hand, the last column on the right, those companies that have policies that have a chronic illness rider, they can't say long-term care, under an accelerated benefit, with the discounting taking place, the death benefit is $300,000. Now, the present value, which means at time of claim, that this person can receive 24% of the death benefit, and that's $72,000. Excuse me, let me rephrase that. They can reduce the death benefit by 24% or $72,000 per year. They reduce the death benefit by $72,000, but the claimant, the insured, only receives $36,000. So the actuarial discount of that death benefit is going to be 50% discounted because it is X number of years before that person's life expectancy, and the feeling is that at the time of claim, that person's mortality has been reduced to a point where they can pay out 50% of the reduction of the death benefit. So each of those 3 years, this insured only receives $36,000 or $3,000 a month as that death benefit has been discounted. When the policy was issued and the premium was set, it was based on a life expectancy of so many years, and those death benefits are going to have to be paid out earlier. The earlier the death benefits are accelerated, the larger the discount. Now again, there are other factors: interest rates, severity of the claim, age of the applicant, how long the policy's been in force, etc. Amount of cash value if it's a UL policy. So lots of factors go into the actuarial discounting. Now, you run into a situation when somebody says, "Wait a minute, I'm losing $72,000 of my death benefit, and I'm only receiving 36. That seems like I'm getting a deep haircut there." On the other hand, if you look at the amount of the premium that person has paid in by the date of the claim, and they're getting $36,000 a year, whereas they may have only paid $5, $10, $15, $20,000 of total premiums up to that point, it's actually a pretty good deal. It just depends on your perspective. So that's how I answer that objection. It's an opportunity. It's a choice that they have. They don't have to take it, but it's there for them if it's going to help the family out in time of need. Under 7702B, typically it's dollar for dollar, subject to the monthly limits placed by that company on that policy. The amount of the benefit is going to be determined up front. A person knows ahead of time when a claim is made what their benefit is going to be under this rider under 7702B. There is no actuarial discounting per se. It is what it is. Because of the significant differences between those two internal revenue codes and how it applies to these riders, it is crucial that the client understand how these benefits are going to be calculated and paid out. And that's why you need to know this, so that you will properly advise your client and help them make the right decision and not have any misunderstanding or family being upset at time of claim. That's why you need to know exactly how these work so that your client knows, and it needs to be documented and given to them, and you need to keep a signed copy of that in your folder to protect your rear end. You may say, "Oh, that's not going to happen to me." Only has to happen one time. Okay, temporary versus permanent conditions. I'm going to spend just a couple minutes on this. Primarily, and again, there are a few exceptions, but not many. Excuse me. If a claim is made under 101G, chronic illness, the claim for chronic illness has to be determined by a medical authority that it's going to be permanent. It's likely only going to pay if that condition is going to be for the rest of that insured's life. To qualify for chronic illness, for example, a doctor has to say, under some policies, for example, that someone has to not be able to perform 2 or more of the 6 ADLs for at least 90 days. Under 7702B, most of the time, these benefits are going to pay for both temporary and permanent conditions. There are some companies that still do not pay for temporary. Most do, and we'll talk about that a little bit more as we go along. Some conditions would allow a person to make a claim under, regardless of what type they have, under both 101G and 7702B. For example, Alzheimer's, which you're not going to recover from; dementia, which typically you're not going to recover from; Lou Gehrig's disease, which you're not going to recover from; Parkinson's. These things are permanent, and someone's just going to, for the rest of their life, going to suffer under these diseases until they eventually pass away. So those are permanent, and we know that. On the other hand, something like a stroke, for example, that may not be a permanent situation, and someone may not qualify for a stroke, because if that policy says it's got to be a permanent condition, only 25% of stroke victims die shortly after having a stroke, and typically only need a short-term period in long-term care to recover and go back and join society. Only 10% recover completely, 25% only have minor lasting impairments, and 40% do have moderate to severe impairments that require some care. But none of those would qualify if the policy says it's got to be permanent. And most of the time that's under 101G, or the accelerated benefit riders that are endorsements that are built in. An accident. Someone may need care for a temporary period of time. Someone who falls. Obviously, the older you are, the chances of being in a permanent situation from a fall, it grows as you get older. Even if somebody was able to qualify for some period of time, not being able to perform 2 or more of the 6 ADLs, benefits wouldn't be payable under a chronic illness rider under 101G unless that situation was considered to be permanent. Tax treatment of the benefits under 7702B, true long-term care, they're going to be excludable from being taxed. They qualify under the HIPAA regulations to be non-taxable benefits. And there's going to be one exception we're going to talk about in just a minute. Benefits paid as an ABR from 101G, they are generally also excludable from taxation, because if it was eventually paid out as a death benefit, that's one of the things that makes life insurance special, is the fact that the death benefit is not taxable. So this is just an acceleration of that death benefit. Now, the IRS has a daily limit, a per diem limit. It was $330 per month last year. This year it has gone up to $340 per month. What that means is, if someone receives a benefit that's greater than that amount throughout the year, anything over that amount is going to be taxable. Now, as I say, this year it's $340. It may go up. It's inflation adjusted. It didn't change between 2014 and 15. It went up $10 a month in 2016. I haven't seen any figures yet about 2017. But $340 a month, which it is now, is $10,200 a year. So, for the most part, you're saying, gosh, that's more than enough to cover everything that we're accustomed to in most states. There are states like Alaska and Hawaii and some states in New England that actually have average costs that or greater, believe it or not. But anything that's paid out in addition to annually the per diem limit by the IRS is going to be subject to taxation. Now, most of us, including me, are not tax advisors, but I do know in the tax code it says if you receive benefits for long-term care greater than the per diem limit, it's going to be taxable. And so some of the policies that have the indemnity benefits built in, where you might receive a considerable amount, if you choose, above the per diem limit, your client needs to know they're going to be subject to some severe taxes. It's going to be added as an additional income. Going to have to be taxed anything above that amount. So something definitely your client needs to know. Most of the policies that have the accelerated benefit riders will not be beyond the per diem limit. And I think that's true across the board, whether we're talking about ABRs or true long-term care benefits under 7702B. Most companies will not pay beyond that. Some will. So this needs to be explained to your client. Under 7702B, these policies, these benefits are standardized, as I say, under the HIPAA regulations. There are 2 ways to qualify: 2 or more of the 6 ADLs and some type of dementia. The claims under the riders under 101G, they are not standardized by law. That's why they're treated differently. They can be similar to the benefits under 7702B, the true long-term care benefits, but there are some differences. Excuse me. Requiring continuous confinement in a long-term care facility, and someone expects to be there for the rest of their life. If that's the case, it's going to pay. If it's not permanent, in most cases under 101G, you don't qualify for a benefit. Some companies say that someone must be confined to a nursing home for 6 months or 1 year, or terminally ill for a certain period of time before it's going to pay. This is an example of why you need to look at the benefits as they are explained and the qualifications for claims with each company that you write with. There are differences among every company, and there are too many to name all the differences in this short session. But it's something you need to take on yourself. Each company will provide you with the documentation of their exact claims, requirements, and qualifications that you need to know, because you don't want to get into a legal situation with a client if they were not advised properly. The elimination period on the 7702B claims is generally 90 days with most companies. It can vary. It can be shorter. I don't know of any that are longer than that, but if someone qualifies over a 90-day period or less, they're going to be able to make a valid claim. Some companies do change that. They can go to 12 months within a facility. They could go to 2 years. They could go to 6 months. Again, this is why you need to be aware of each company's provisions on claims. Now, I'm going to conclude this part of our presentation, but I've got some charts I want to show you, which will let you sink your teeth into some differences among different companies and know better which companies provide the best, the richest, the most robust benefits, whether it be accelerated benefit riders or long-term care riders. So in conclusion for what we talked about, you need to know the difference between those benefits that fall under 101G, which is basically the acceleration of a death benefit, and 7702B, which is true long-term care. It fits all the legal requirements of those benefits under the regulations. And you can call it long-term care because it is long-term care. You need to know how to explain accurately the differences between the riders and the options that they will have down the road. Okay, let's look at 3 charts right quick, and then we'll open this up to questions. I appreciate your patience. I know that was not a lot of fun, but hopefully I did emphasize the need for the knowledge to know the difference between 101G benefits and 7702B benefits. Now, I have cheated, and I've got the best chart that I could find comparing accelerated benefit riders. Now, these are ABRs. They're all going to fall under 101G. They're going to be chronic illness. We can't call it long-term care, and we don't. Okay? Now, I cheated because I'm using this chart that was created by AIG Partners out of Nashville. I will say this up front. Of the companies we work with, and most of which you work with, the ones I'm most familiar with and know about, whether I work with them or not, the 3 companies that offer the best accelerated benefit riders in general, and this is in no particular order, you can draw your own conclusion from some of the things you're going to see on the next 3 screens. The 3 companies are AIG Partners, American National, and Life of the Southwest. Those are the first 3 that you'll see on this chart in front of you now. AIG Partners earlier this year made sure that there is a minimum payout on a accelerated benefit riders because some companies have provisions when they calculate what's going to be offered at time of claim. It may be under their minimum, so you get nothing. You'll see here that with their quality of life products with AIG Partners, they do offer a minimum payout, and the same with North American. Those are the only two companies shown here that offer a minimum payout. Now, let's go back up one row. Available chassis. AIG Partners offers these riders on all their policies. Life of the Southwest on all their policies, but they do not have a guaranteed UL. And I believe, in my dealing with the public right now, for the most part, the majority of people want that guaranteed part on their UL. American National on all their products. North American only on some of their UL products. And Transamerica only on term products. So you need to know which is applicable before you go in and talk about these ABRs. Okay, look at the chronic illness maximum acceleration. The third or fourth row down. $2 million for AIG Partners, $2 million for American National. Those are going to be the highest payouts available. Critical illness maximum acceleration. Now I'm talking about critical illness for the first time. $2 million for AIG Partners. American National also $2 million. Theirs is limited to 65 and younger. Those are the highest potential payouts, of course, depending on the size of the face amount of the policy. Terminal illness, $2 million for AIG Partners, $2 million for American National. American National, again, limits it to 65 and below, then they drop down to $1 million. Waiting period. No waiting periods for American National and North American. 30 days for AIG Partners. 2 years for LSW on the chronic illness and 30 days for the critical illness. So you see some differences there. And finally, on the bottom row, available on all underwriting classes. This is important. I had a case last week. I had two gentlemen. They were brothers. They had an inherited condition with their kidneys. They're going to be table 6. Guess what? They would only be able to get those accelerated benefit riders with American General Partners because of their underwriting classification. That's very important to them because they have basically cystic fibrosis of the kidneys. It's going to get worse as they get older, and they'll probably have to have kidney transplants at some point in life, as their mother had to do. They inherited it from their mother. So table 6 has a pretty hefty rating. You know why they bought the policies? Because they're going to be able to have that accelerated benefit on their policies in case and when and if they have to have those kidneys replaced. So little things like this that you know allow you to pinpoint and determine what's going to be in the best interest of your applicant. That helped me make the sale because I could put them somewhere where they got the ABR. Okay, here's the second of 3 charts we're going to look at. The accelerated benefit riders, again, continuation of the first chart. You'll see that the qualifying conditions across the board with the same companies we just talked about, you can look at what is required, and pretty the same across the board, a few little differences, but mostly the same. But what's most important is the next wide row that talks about qualifying conditions. What will be looked upon as a valid claim? They're all going to have heart attack, stroke, and cancer. And then it begins to vary from there. Take a look at both American National and LSW. They offer more coverage for more conditions than any other company. AIG Partners has 9 plus, as you see in red. North American, in all honesty, and North American is one of my favorite companies, but when it comes to their accelerated benefit riders, they actually have the weakest value for the ABRs. So if the ABRs are something that's particularly important to your client, you may want to look somewhere other than North American if they put a high emphasis on those ABRs. They're very limited in what they'll cover, only 5 different conditions. And of course, Transamerica is limited only to their term policies. Again, AIG Partners, LSW, American National is on all their policies. North American, UL only. And you'll see on the last row there the terminal illness qualifying conditions. The only difference there is that Transamerica says that the death by is expected by a qualified medical authority, so that death is expected in 12 months or less. The other companies is 24 months. Okay, here's the last chart I'm going to put in front of you. These are important to know, and you may want to review this at a later time so that you know that you're up to date on which companies offer what in terms of ABRs and, on this chart, optional additional riders. So even though, and you'll look at the first 1, 2, 3, 4 rows here, these are chronic illness riders. Now, if I say chronic illness, you know that comes under 101G. The last 4 are LTC riders, true long-term care riders that come under 7702B. Okay, they're optional. There's additional costs for these riders. And the main thing is they're going to pay out dollar for dollar. If I get a benefit this month of $2,000, I know that $2,000 is coming off my total death benefit, not to be discounted as ABRs are. These are not endorsements. These are optional add-on at cost riders at time of sale. Your client knows what they will receive if they have a valid claim somewhere down the road. Okay, let's look at the first row. Okay, with AIG Partners, it's going to be a rider. It does not require the condition to be permanent. It's the only one of those 4 chronic illness riders that doesn't require the doctor to say, this is a permanent condition. That's significant to know. On all the LTC riders, it must be, because if it falls under 7702B, there is no requirement for it to be permanent. Okay. Under AIG Partners, their rider, their chronic illness rider, up front, you have a choice to choose 2%, 4%, or the IRS per diem at time of claim. Not what it is when the policy is issued, at time of claim. The cost is greater for the policy if you choose 4% instead of 2%. It's a little bit greater if you choose the IRS per diem at the time of claim. Now you might say, well, which one should I put down? Depends on the face amount. If the face amount, rule of thumb is greater than $500,000, you should choose the 4% because that's going to be greater probably in that person's lifetime than the IRS per diem is going to be. If it's $500,000 or less, go ahead and choose the IRS per diem because that's probably throughout that person's lifetime going to be greater than the 4% of the death benefit. Okay? Now, you'll also see on that first row under American General Partners, it says adjustable benefit base, 50 to 100%. You have the benefit, you have the option at time of application to choose how much of your full death benefit you want to be exposed to this acceleration, to this payment under the claim on this rider. You may want to preserve some of that death benefit not to be invaded by using it for long-term care. You could choose 100%, you can choose 50, or anywhere in between. Again, some flexibility at time of issue. Notice that all the companies except for John Hancock will waive monthly cost of insurance mortality charges if someone is on a valid claim. And that's a pretty big hole in that rider for Hancock, because you typically think of somebody being on a claim as not having to pay any premiums. So that's something that they need to look at fixing up, because virtually every other company that has these additional riders, it is a waiver of monthly insurance charges in the policy. Okay, let's see what else. Indemnity on each of those first 4. payment without any billing. The last four, under the true LTC riders, there is some degree of needing to prove that there are claims made. The worst, again, is Hancock. They're going to reimburse costs. The others, you just have to verify that there have been some costs incurred. So again, Hancock would not be your favorite if you're going to choose an LTC rider. The companies have different payment options. I mentioned what AIG Partners had. Prudential says you're limited to 2% of the face amount. Protective will go anywhere from $1,000 a month up to the IRS per diem limit, because that $10,200 is the equivalent of $340 a month, which is the current per diem limit by the IRS. They're not going to pay out more because they don't want to get into the tax situation. So they're not going to pay out more than $10,200, which is the max that can be paid out or received without being taxed. Lincoln National limits you to 2% of the face, as does Pacific Life. You do have some choices with Hancock, and 2% both with Nationwide and Transamerica. So basically, that is kind of a quick glance at some of your major carriers, some of which you have access to, some of which you may not. But it gives you an idea overall which companies pack the most value into their ABRs and or their optional, at cost, additional riders. It shows you which ones come under 101G and 7702B. It shows you which ones pay out on an indemnity basis. These are things you need to know before you consult with a prospect about purchasing a life policy that has these additional riders, whether they be ABRs or additional at-cost riders. Now, I know I threw out a lot of information, and I know you hopefully realize the importance of the knowledge of how these riders work and under which sections of the Internal Revenue Code they fall, because that's how it's going to impact when one of your clients makes a claim. You don't want to have that old story come up saying, well, my agent didn't tell me that, or that's not what he said, or that's not what she said. You need to make sure that you know that you have conveyed and communicated properly and clearly and accurately how these claims work. You need to have a copy of what you have stated, and you need to have it signed by your prospect to cover yourself down the road from any unnecessary legal costs. Now, with that, Mark, I'm going to turn it back over to you guys to see if there are any questions, hopefully those of which I can answer.
Thank you very much, Bob, and a wonderful presentation of information. Thank you for gathering it all and putting it in a format that really let us see it in a way that we can understand. I think most importantly, as you brought out in the very beginning, this particular presentation has been recorded, so it will be available on our library for you to go back in and review, because I think there's so much information, as you said, pertinent information, that we really need to get it fully understood. So again, Bob, thank you very much. I notice, Helen, you've got your hand up. If you've got a question, if you can type it into our question box, because we are muted, so I won't be able to have access if you're not on a computer where you can bring that information back to us. And yes, Bob, we do have questions coming in. The first one we have, and some of the questions, as usual, may have already been covered as you went through additional information. I take it, Bob, you can't see the questions, or can you open them up?
Let me try to open up the questions, Mark.
Open up that little arrow that's left to right.
Yeah, I did, okay. But I don't see the questions, Mark. I do not.
Well, let me read them off to you then, please.
Okay.
And Paul is out there. Paul Roman is with us often, and Paul has a number of very good questions. The first one is, when is asset-based long-term care rider better than an annuity-based long-term care policy? So when using life insurance versus annuity versus
Okay,
long-term care.
gotcha. Good question. There are two main points I would like to make. First of all, if the asset-based benefit is on a life policy, you're going to have an initial potential higher benefit. However, if it's under an annuity, as that annuity grows over the years, the annuity is going to, as it grows, is going to create a larger and larger and larger long-term care potential benefit. So the answer to that is, depends on when the claim is, because early on, the life policy is going to provide a better benefit. Later on, depending on the growth of the annuity, which is going to create a larger long-term care benefit, if it occurs later, the annuity will have been the better of the two. Now, here's the other point. That's the first point. The second point is that sometimes we have to, it's not our choice. Many times, someone's health will determine whether they are better for the life policy or for the annuity, because the annuity has very, very minimal underwriting, because you're not underwriting for the potential death benefit. You're only underwriting for that on the life policy, where you're looking at mortality and morbidity. It's much easier to qualify health-wise for the annuity than it is for the life policy. So sometimes it's not our choice or the client's choice. It's what they have, the only thing that they may qualify for. But those are the 2 points I'd like to make to a very good question.
Thank you, Bob. And once again, Paul's coming back at us, and he's asking if you have an example, I guess a document that could be used when we're explaining to the client these benefits that they would sign off on and we would place in our records. How would you approach that?
Okay, another good question. Probably, and here's what I do, Mark, and this may not be the only way, obviously, may not be the best way, but what I do is obtain from the carrier, because it's going to depend on the carrier, because there are differences, some minor, but there are always differences from one carrier to another. I either get a brochure or a document from that company, whatever they offer. I go over that with the client. I leave them a copy. I keep a copy that they sign on that brochure or that statement or that documentation to state that I have covered that, they understand it, and they agree to that. I keep a copy, and I give them a copy. So it's going to be either typically a brochure, or some companies have sometimes a 1 to 3 page document explaining their ABRs and long-term care riders. Because there are always differences from one company to another, I have to use the particular piece from that company in order to properly document what I have gone over and explained.
And that makes perfect sense, and it certainly would be, I think, the simplest. The brochures are definitely available from all of the carriers that we've had up on the screen today. And of course, as you said, going back to the companies for documentation. But I think the brochure is a great idea, because it's all right there.
Absolutely.
All right, so I think this question kind of answers itself, but we'll go back to you with it. And that is, if someone takes their accidental or their accelerated death benefit under a 101G type of program, and the policy then expires, are there taxes due at the point for that policy at that time?
No, those benefits have been, and generally no, and again, I'll qualify this by saying I'm not a tax advisor, Mark, but I've been doing this long enough and do enough research and look at my tax facts whenever necessary, so I feel confident in my opinion, and it's only my opinion, in that the expiration of a policy, because of the payments of accelerated benefits, again, the expiration of the policy is really a non-factor. It's the fact that those benefits were paid out as what was otherwise a death benefit, which are under Section 101G non-taxable.
And that makes perfect sense because it is a 101G.
Yes.
Okay, and we have one more question here, and that is, and I think again it's answered in the presentation, but is there a website or service that helps us sort out the best ADBs when looking at the term versus the permanent? So again, I think perhaps this is something that came in as a question before you showed that final screen that's still on the board behind us.
Mark, I think you're right. For what I've been able to do, and I've done these types of presentations for probably the last, I think the first one I had recorded was back in 2012 when we were just beginning to get into this and understand it and know the ramifications and the accelerations and the reductions and so forth. This is the best that I have been able to assemble over the last 4 years, is what you see right here in front of you. Now, I won't say that there aren't other sources that are better, but this is the best that I've been able to see, find, and assimilate over that period of time.
And again, Bob, thank you very much for taking the time and putting this all together. Agents, again, for your information, all of these carriers that you're seeing are carriers that we work with and that we work with through Benchmark. So if you are not currently appointed with any of them and that's kind of triggers an interest to you, let's